Well, good evening, everybody, and welcome to the August 2022 Investing Roundtable. The cover shot there is the U.S. Open. I learned last night that you can get nearly 24,000 people in there to watch a round of tennis or pickleball, Herb. Quite a fantastic setting, and I just thought it kind of captured the moment. If you got a chance to catch Serena and last night's performance, it was something else. Well, welcome everybody. My name is Mark Robertson. I am joined here by three dear friends that are long-term investors that like to share what they've learned and in the hope that will help others become more successful. Welcome, Ken Kavula, Herb Lemkool, and Hugh McManus. How are you guys all doing tonight?
It's a good evening to be around, Mark.
Greetings from Northern Michigan.
And California.
Yeah. So greetings from Northern Michigan. The picture of me is at Moomer's, the ice cream that's been the most famous ice cream in the United States. And even our illustrious president visited there when he was in Traverse City. So on your birthday, you get whatever your birthday is off on your ice cream. So I had 81% off.
Now, Herb, I'm a little disappointed not to see some Michigan cherries in that ice cream.
Yeah, well, they didn't have any. I asked for the cherry Moomalee, and they didn't have any that day.
Good to hear your Pony ID is working.
Hey, Herb, is this where the cows are? Is that where you went to get the ice cream, or is this down near Traverse City where you got it?
Yeah, it's down where the cows are down about, it's about 6 miles from our house.
So you went actually to the farm where you can sit there and eat your ice cream right next to the cows that gave the milk for it. Great.
Exactly. Yeah, it's a beautiful spot.
Definitely God's country, and we need to move on, guys.
Okay.
All right. Here's our standard disclaimer. We're many familiar faces on the roster here tonight, but there could be some new people. No investment recommendation is intended. This is an educational demonstration. Everything we talk about here tonight is in the spirit of sharing basically lessons learned over the last 8 decades with the Modern Investment Club movement. Everything that we do is for illustration and demonstration. We're showing the way that we discover and explore and basically torture ideas to see if they are good investment opportunities. So you're going to hear opinions from us tonight. Please do your own homework before making any decision. If we own something that we're talking about, we'll try to remember to admit it. If you'd like to be reminded with an email, we do this once a month. The roundtable now, we're in our 13th year. Please send an email to nkabula1@comcast.net, and Natalie will add you to the list. To be reminded, she will not inundate you with email. She'll simply let you know when these type of educational sessions are happening. If you'd like a copy of the slides or if you have follow-up questions, the 2 email addresses, markr@manifestinvesting.com and kkabula1@comcast.net, can be used to achieve that. All right. Well, here's our standing agenda. Again, welcome if you're new here. We do try to keep this fairly informal. If we leave any time at the end of the session, if there's any time available, we do have an open Q&A. So welcome. We are going to talk a little bit about bullish lessons, which we have covered with the roundtable as the centerpiece here over the last month or so. We will talk about performance. We do keep track of how well the selections we suggest to study do over time. We do engage in a little bit of portfolio management, although there's not much here tonight. And the 3 stocks which will be presented are Fox Factory, Dollar General, and 3M Company. Hugh is going to basically defer to a future month for now, but he is invited to make comments as he sees fit. All right, just a quick reminder of what this is about. We've been doing this for a little over 12 years. We're simply attempting to share an idea, how we basically discover that idea and analyze that idea. We do it monthly and basically at the same time, generally on the last Tuesday evening of the month. We do some frisky investing with what we would call special situations or non-core selections, but keep them limited a little bit. And our overall goal is for the collective performance of the stocks that we suggest is for them to beat the Wilshire 5000 by 5 percentage points. And we'll actually talk about that. And we would like to see the majority of our selections outperform the general stock market. One thing that I did want to do for just a couple minutes is go over a couple of things that we've covered in the bull sessions. Ken and I host bull sessions at 2 o'clock weekly on Tuesdays. And this is from a few weeks ago when we began dabbling in a Peter Lynch quote, which we're going to actually walk through. And I think it makes a fairly powerful point. So Ken, go ahead and chime in as you wish. This is the quote, and I really think that our experience with the roundtable is beginning to bear this out in bold color.
I'll tell you, those of you that are in investment clubs, you can get these slides on YouTube, or you can send an email to mark@manifestinvesting.com, and he'll send you the slides. But putting this slide up in front of an investment club, followed by the next slide, and then taking 3 or 4 minutes to discuss what they're actually saying, I think is an exercise that every single club that I've ever visited could benefit from. Sometimes we forget that there's limited downside in a stock. You can only lose what you invested, but there's unlimited upside in that same stock or in any other stock that you buy. So you can quintuple it, you can multiply it by 10, you can even multiply it by 20 or more. And we're going to show examples of that as we move through our portfolios in the next couple of days. Here's our worst performers from the roundtable portfolio. And you'll notice that most of them have yellow backgrounds, which means we've tried to get out of those positions before we lost everything. Sometimes we didn't come very close on our fossils, for example. We lost 80, 85, 90% of the holding before we finally decided to exit the holding. But these are the worst things that we possibly could have held. Notice that the only worst performer that we're holding on to right now is ARDX, and I think that we've formed an emotional attachment to this particular stock.
No,
and,
just a lot of faith. And the one thing I would point out about Fossil is I would accuse us of being stubborn on that one also.
Absolutely. We pegged what was happening to Fossil in 2015, 2016, but kept saying that maybe that wasn't true. And you can see it took us all the way to 2018 in January to exit the position. We did some cleaning out of things. A great example is 3D Systems, where we successfully identified a future trend. And back in 2013, talking about 3D printing was a new trend, something that was going to revolutionize a lot of manufacturing. It has, in fact, revolutionized a lot of the ways that manufacturing develop parts and create parts and create systems of mechanical devices. But we forgot that just because you can identify the trend doesn't necessarily mean you identify the company that's going to benefit from that trend. And 3 years later, after losing about 3/4 of our investment, we decided that that company was not 3D Systems that was going to benefit from that 3D printing trend. Lesson learned. We learned it a couple times, and I think every time a new trend comes through, we tend to relearn it. I know a lot of you learned it back when PC computers, when computers in general were just starting to become something that was available to the general public, and there were many companies out there selling them. We knew they were going to make life different. They were going to be earth shifting, but picking the company that was going to benefit from that shift in the way we thought about dealing with computers was much more difficult than we ever realized. Let's go to the next slide, Mark, because it's equally interesting.
Yeah,
And that,
before
go
we
on.
transition to that slide, let me just point out that, first of all, ARDX is a work in progress. It was recently as low as 57 cents. So it's actually had a pretty good run. And the other thing is just notice how quickly those numbers are. Those are big losses for a position they all started at 1,000, right?
Right.
Notice how quickly they are increasing. And again, this is out of a sample size of approximately 700, and that leads us to this one. And
this is the other slide that I really think that if you have the opportunity to put this in front of your investment club, you should do it, and then you should discuss it. Why don't you walk us through the slide, Mark?
yeah, I think it's just phenomenal. I mean, every time we make a decision, whether it's a knight, a damsel, or the audience by vote, we put $1,000 into each company, and then we went back and looked at, well, how many of them actually have values less than 1,000? And I was actually a little bit stunned that it was 222. That's 30% of the selections. Now that's during a particularly challenging time in the market. But you look at the cumulative loss, simply adding up all 222, it's about $60,000. And then you come to the reality that the gains from Microsoft alone, that one company alone in the roundtable portfolio, actually overwhelm and absorb or offset the loss from those 222. I mean, it's just a staggering reality that Peter Lynch has shared with us. And I believe we've got Hugh and Ken to thank for the selection of Microsoft.
It's when you sit down and you talk with your club about how you're doing and everything, clubs tend to focus a lot of times on the negative, on missed opportunity, or on stocks they've made mistakes in. But a lot of times your very best stocks are some of the ones you might pay some of the least attention to. They just do well on a kind of a repetitive, boring basis, and you expect them to do well. But expecting one stock to balance out the loss of the 222 losing selections in the portfolio is really something I never anticipated, and yet here it is in black and white and a couple of other colors. It's just a fantastic point, I think, to continually make. You only have to hit a couple of really big home runs in an investing career in order to make your nest egg, sit at a place where it's not going to be at the whim and mercy of Mr. Market.
And that kind of dovetails into the next issue here. This is actually from this afternoon. For those of you that attend the full sessions, sorry for the repetitiveness, but we thought we wanted to share this with a little wider audience. And we talked about some of this roundtable stuff also, and it has to do with this quote from Morgan Housel that points out that it's a very similar theme, that a majority of Warren Buffett's riches come from a relatively low number of stocks, even though he's owned, it's estimated, between 400 and 500. And I assume that's Berkshire Hathaway, not just Mr. Buffett. But Morgan Housel is a fantastic writer, and Ken and I have both promised to read that book. If any of you out there have read it or have any commentary on it, we'd like to hear from you. But what we basically did is went back and looked at the first selection of all of these companies, and these are the single positions. So each one of these was $1,000 at the start. And you can see we've listed just the top 40 companies as a sampler. And it's just really kind of phenomenal when you start thinking about how much profitability and contribution to the portfolio comes from a relative few. And we'll hammer that home with the next slide. But look at the wide, very diverse set of companies. And again, I'm kind of glad that Hugh's here because look at those top 3 positions. Hugh, would you like to take a cyber bow?
Yes, a lot of it is luck, you know.
But yeah,
Don't know when to grab your luck.
what are you generally thinking when you latch on to a Costco in 2010?
I like to run into fires. So when prices are low, that's the time to buy. I know earlier people were complaining about what the stock market's doing. Perspective I have is, ooh, this could be a good time to buy. Not really as worried as to what I own. And Amazon was kind of clear to me at the time. It was, well, it must have had a price split since oh yeah, the price was 127. That's right.
Yeah, that's completely split adjusted. So yeah.
Yeah. But it was obvious to me back then that it was selling at a bit of a discount, you know.
Mm-hmm.
I like it when bad things happen to good companies. That's all.
Yeah, and in that spirit, I mean, EPAM Systems is the one that we talked a little bit about this afternoon. That company got hammered by the Ukraine situation, and man, have they ever bounced back. That was not the end of the world, what happened over there, and they've really come charging back. But the other thing that I like about this list is, again, the diversity of all the companies, but look at the contributions from everybody. Audience, Cy Lynch has a bunch of them there. So does Ken. And some very fascinating contributions from Kim with McGraw-Hill and companies like that. PayPal had a real strong contribution. What strikes you, Ken? What jumps off the page at you?
Well, we talked a little bit this afternoon about a couple of the yellow background folks are positions that we closed, and in that end date column you can see when we closed them. But we talked a little bit about our rules that we use to manage this portfolio, and we think they've really improved the performance of the portfolio. Let's get that out there in front of everybody, that our rules about looking at losses, at quick losses, about looking at relative value numbers, about taking into account what future pars might be. We think those rules are serving us fairly well, but we did notice some notable exceptions that maybe they will tell us that our rules need a little bit of either exceptions being added to the rule or maybe a little bit of tweaking. Look at number 8, Apple. And you move across that column, you see we picked it up at a great price. Now this is split adjusted, so we didn't actually buy it at 10.22, but we bought it at a great price, split adjusted 10.22, and we sold it at a split adjusted 78.10. Keep in mind, however, that it's trading right now for somewhere around 155, 160. That would have been a double in about 2 years, a little bit more than 2 years, if we would have held it. There has to be a way for us to do the pruning in our portfolio when it's necessary, and at the same time look at some of these exceptional companies and ask ourselves, are they so exceptional that we maybe need to give them a pass from the chopping block? The other two that I had in mind that I brought to the group were ResMed, which I continue to hold in my personal portfolio, and which also has performed very, very well throughout the pandemic, and Dollar General down at number 36, which I also hold in my personal portfolio, and which also has performed throughout the pandemic in a pretty stellar way. We got rid of all 3 of those in 2020, and maybe we need to talk it through with certain types of companies, some of the highest quality companies with the straightest possible sales lines and earnings lines, and the companies that maybe should be given a little bit more of a pass before we just jettison them entirely from the portfolio. It's just a work in progress. Portfolio management is always a work in progress, and the goal is to make the portfolio better. So I think that what we've done in the last 10 years has continued to improve the quality of the portfolio. I look at some of the decisions we made back when we started this this whole concept, this whole idea of putting together this tracking portfolio, and we've become much more disciplined, and our performance has moved to a place where we're extremely proud of that performance.
Yeah, and keep in mind that what we'll probably end up doing is taking a look at case studies with Apple and a few others to see if there is some fine tuning that needs to be done. The other one I like to point out here is Hugh's infamous moment where he said, "I want to buy a bank," and it's now preserved for all prosperity right there on the list. And for those of you that have avoided banks and insurance companies, you don't want to. Here's Aflac also. You want to figure out how to take advantage of those type of opportunities. And I think we've done a lot of work in that regard, very important work in that regard, Ken.
Absolutely. I still visit a lot of clubs, Mark, where they don't have any financial sector stocks. And I still try to make the point that there's good money to be made in the financial sector. You just have to know what you're buying, and you have to be able to evaluate it in slightly different terms, using slightly different vocabulary. But the basic underlying evaluation of a financial sector company is the same as any other company you look at.
Absolutely. So here's the list of the companies that the 10 largest total profit positions. Now, this will be all the positions. In other words, 5 times invested in Microsoft. You can see that the information on the slide is a little bit dated, but $5,000 invested into Microsoft has become approximately $60,000. So 5K. And you sum up just the top 10, and you actually come up with a number that's nearly 60% of the total profits in the active portfolio. So again, the point being made, we've featured nearly 250 stocks during 12 years and made most of the profits in just 10 of them. And again, that then includes the multi-selections. So that rhymes with what Morgan has pointed out about what is possible with portfolios. So pretty fascinating stuff. The other thing that I find interesting about are the roundtable track record. Because I had started out from the very beginning really trying to focus on new companies that we hadn't covered yet, and then Cy and Ken began going back and began making repeat selections from within the portfolio, and we've kind of achieved about a half and half balance if you go back and actually look at the trailing 12 years. And I think that's a pretty good balance to have, where you're basically accumulating within the current tracking portfolio, but also coming up with a couple of new opportunities. Anything else you'd like to add, gentlemen? And again, Costco just jumps off the page at me. That's a one-time investment in Costco, $11,000 at the time the slide was prepared.
Mark, I think it's really important to note that some of those stocks we should have continued to invest more money in as we got through it, but we only did once and we never went back to them.
Yeah, we talked about that a little bit this afternoon. Absolutely. All right, let's go ahead and press on, guys. Here's the collective performance. All that stuff adds up to this. We are continuing to beat the market by 5 percentage points, the relative return of 5. Our rate of return, along with everybody else in the investing world, thanks to Jerome Powell. That was for you, Sean. 15.4% rate of return versus the Wilshire 5000 over that same time frame, 10.4. The 15.4 minus 10.4 gives us a 5% relative return. That's what you see graphed right here. And it's not easy to do that. We're thankful. We're grateful. We've been lucky. And but the discipline and the patience does pay off.
I think we want to make the point also, Mark, that most large mathematical models when you're graphing something in that model, have a tendency to go back to the mean, to revert to the average, even though they might swing wildly above or below whatever the benchmark is. And I'm just fascinated with that Wilshire 5000 number that's at 10.4, when we know that over the last 90 or 100 years, that number has been somewhere between 9.5 and 10.5, depending on how you measure the market. The market's not at a place where it's dismally returning money. The market's at a place where it's returning about what it does on average over a fairly long number of decades.
Good stuff. So hopefully we can maintain that going forward. We do keep the current tracking portfolio at the public link that's shown down here at the bottom, so you can actually see the active positions in the portfolio. What is shown here are the top 20 positions by percent of total assets. So you can see that Microsoft is the top position in the portfolio, along with some of the companies that we have been discussing. There's Costco at 11,000. The legend up at the top tells you how many times a particular investment has been chosen. In the case of Microsoft here, in the number 1 slot, it's actually been chosen 5 times. So that means that a total of $5,000 has been invested in Microsoft. So you can break down the entire chart into what you see there. Here's a look at the overall portfolio. I'm going to kind of just go through some of the stuff a little bit quicker than usual. Pretty decent growth. Pretty decent financial strength, and maybe a little bit strong on the growth. Quality is very good, excellent, and the projected return is just a little bit short of the sweet spot, which is 5 percentage points above the average or median return forecast right now. So we're a little bit short on that, and all we can do is just keep trying to make good selections. The 5 stocks that you see shown here are in the tracking portfolio, and they have the lowest return forecast, the lowest projected annual return. Again, that's similar to section 5 of your stock selection guide for the projected annual return. And if a company were on the hot seat, and we're going to argue that none of them are right now, First Financial with a 3.9 would be the lowest. That is the closest to the 30-year Treasury at a little over 3%. But much like we were just talking, I think First Financial gets a bit of a pass due to some of these characteristics.
Mark, we have a good question from Carlos out in the audience. He wants to know, is there a reason for using the Wilshire 5000 rather than the S&P 500 as the benchmark?
Well, the Wilshire 5000 is going to be a little bit broader in terms of capturing some medium and smaller sized companies. But the fact of the matter is, over the long term, because of the market cap weighting, there's actually very little difference between the two. Just a little bit of a nuance to having more of the medium and smaller size companies, and we love all of the above investing, so that's why we use the Wilshire 5000. Whereas the S&P 500 is all large companies.
I guess the only index that we would shy away from using as a benchmark probably would be the Dow, right? With the Dow being so dependent on 30 very large stocks.
Yeah, 30 very large, and 12 of the 30 are cyclical companies.
Yeah.
Yep. But they do it. Actually, the Dow 30 does capture pretty representative way the performance of the market. All right, one of the rules that you heard Ken talking about in a positive way is the rule of 5 that we pay attention to. If a company is selected and actually drops much more rapidly than the market, or much more than the market goes down, we begin to pay attention to it as a potential sale when it crosses minus 20. And we do give ARDX that exemption from punishment. But PayPal and Boston Beer would be on the hot seat. I think both of those are probably pass closer study, but they have been in quite a slump, and we're hopeful that they will turn around. But they are not off our radar screen. We're not ignoring them.
I also think it's very fair to say, Mark, that this rule of 5, this rule that we put together before the market started its misbehavior, in the last 5 or 6 months. I think that this rule is much more difficult to deal with when the market is making huge jumps in both directions on a fairly regular basis. It doesn't make as much sense on it when we meet only once a month to look at these big swings as maybe it did back when we were going through 4 or 5 years of relatively well-behaved markets.
Mm-hmm. All right, and just wrapping up, we do keep track of buying opportunities with the relative strength index. And again, this is just one piece of the puzzle. Kind of interested to hear your thoughts on this one, Hugh. Bristol Myers has been getting punished quite a bit to the point where it is potentially oversold. Is it on your radar screen as a potentially attractive company?
It is, yeah. I've been watching Bristol Myers Squibb recently. Over the years, Bristol Myers Squibb has had its ups and downs, and I've always been able to buy it when things are apparently not going well for the company. It always bounces back. It's an interesting company in that it's an agglomeration, really, of, at this point, probably 100 emerging pharmaceutical companies that it's bought. And at one point, when I looked at the company 10 or 11 years ago, it actually had not developed a drug in-house for over 30 years. Everything that it had bought. An interesting entity, BMS, or BMY as the ticker would go by. But yeah, I continue to buy that company when the opportunity arises.
Yeah, and notice that these $5,000 investments are all in the 1,400, 1,500 range. And it really is just this more recent excursion downward. I don't know if they have any Zantac influence or not. I mean, that's killing Glaxo and a couple other companies, Sanofi. But yeah, it could be an interesting opportunity. Then we also check for any relative strength index ratings greater than 70 as a potentially overbought and a potential selling opportunity. There aren't any right now. Again, thank you, Jerome Powell. Yeah, I'm kind of picking on Sean a bit here.
I keep checking the list of who's here, Mark, to make sure he hasn't shown up. You know,
he'll probably leave. He'll just get upset with me. All right. In the case of ARDX, and I don't know if you can say anything, Hugh, but our position, and we watch this one fairly carefully, is that the thesis is unchanged. The price got massacred when they disapproved the drug about mid last year, but they continue to try to fight their way back. And this is just some news. Do you have any comment, or are you able to make any comment on this, Hugh?
Yeah, I'm in a bit of an awkward position. Somebody figured out that I was yakking on about ARDX a lot, and I had mentioned I was going to be changing jobs in April of last year. And then, I stopped talking about ARDX about the same at that time as somebody discovered. They put 2 and 2 together and said, well, they asked me, can you not talk about ARDX now because of your new job as well? If I answered yes to that, I'd maybe violate a confidentiality agreement. I don't know. If I say nothing, I'm probably violating it as well. But I don't know anything that the public would know about this company, and it's a company that I have bought quite aggressively. I had to stop buying it once I changed companies where I work. But in terms of just looking at from the outside at this company on the news, it will all hinge on what the FDA decides later this year. But it's pretty clear from all indications that it has a drug, and that this drug works. It has strong advocacy from patient groups, which is always good, but never guaranteed when you're bringing a drug to market. It has launched a drug for another indication for irritable bowel syndrome. That could be a large market, but it's the market that it's after for in potassium that is potentially the really big one.
Yeah, and again, they seem to be on track. It's my understanding that a large number of doctors and nurses are ready to march on Washington and testify on behalf of the company that the trials have made patients' experience and quality of life better. And so it'll be interesting to see what happens. And again, it's just the company is taking another shot at the basket, and we'll just wait and see what happens in November. Is kind of my impression. So, Ken, that's
Mark, Would it be fair for me to say that at the November roundtable, we can either celebrate ARDX or put it to sleep for good?
Why you don't like ARDX?
It could be.
I would say what might happen I would expect the FDA to say the following, because they want to keep all the parties within the agency happy as well. And so they're likely to say, at least this is an outcome that I would be pleased with, is that we'll approve it for the phosphorus indication, but you have to do a clinical trial to support it. So they might ask them for another clinical trial. Given approval, so you have to do another supporting clinical trial.
And it's likely that that type of response from the FDA would lead to optimism for the stock.
Well, no question about that at all.
So
I mean, when I say it's a drug, it doesn't, it's not going to get turned on because of side effects or problems in that area. The only issue is whether it works for the indication. And the answer is yes, it seems to. I mean, that's what the clinical trials to date have shown clearly. But they might want to do another confirmatory one. But we'll see. Who knows?
Well, we'll keep our fingers crossed. By the way, my position at 57 cents is leading in the standings for this year.
Excellent.
In percent gains. So
Okay.
one out of the ARDX positions is doing its job. All right.
All right.
Ken, let's switch gears and take us away with Fox Factory.
Okay, this is the August roundtable, and I'm a director from the Mid-Michigan chapter, and I'm going to talk about Fox Factory. Next slide, Mark. I chose Fox Factory after looking at the top of the sweet spot. I went to the place where in the portfolio, in the roundtable portfolio, where the sweet spot ends and the yellow background stocks begin. I captured the middle of that list right there for you to take a look at. I seriously considered the two above that red line that Mark drew and the two below the red line that Mark drew. I especially considered making another addition to Alphabet and decided you were tired of hearing me talk about Alphabet. So I looked for something else. I wasn't especially eager to move to MKS or First Foundation. We've had a number of presentations on those recently. So I looked for a new company and I discovered Fox Factory. If we add it to the portfolio, and we'll add it as my choice, it will certainly be a new addition. Next slide, Mark. So what does Fox Factory do? Well, it basically delivers parts to people that like to do sports that are associated with motorized vehicles. So think off-road four-wheelers, think two-wheeled motorcycles, think anything that might have a motor or might even be self-propelled and that has wheels and that you play sports with or that other people do a race to entertain an audience. Next slide. The consumer base is not what you would expect. They don't sell their things basically to the general public, although these items are available for the general public. Their best customers are actually at the pro end of the customer base, the ultra enthusiast and the weekend warrior, the wannabe pro. And these are the people that tend to want to buy the best possible equipment and then see what they can get out of that top of the line equipment. Next slide, Mark. It's an aspirational brand. It's used by many, many pro athletes. And then this last group, these die-hard evangelists, people that like to brag that they're using the same equipment as so-and-so who's the champion of such and such. Next slide.
Are you going to get one of those tattoos, Ken?
Yes, tomorrow. The next slide. Okay. Fox Factory operates in two divisions. The first division is the Specialty Sports Group. Next slide. And they make, here's some of the parts they make. So you're looking at wheels for racing bicycles. You're looking at parts. This is a T-bar on the left right there that goes into bicycles that's high performance. And the numbers of pictures on their website of the different kinds of things they make, suspension systems, things to make the wheels turn more smoothly, to turn with less friction, all kinds of things. You can find those on their website, just like I found this graphic right here. Next slide. There's a lot of opportunity for growth, and the biggest opportunity is in market expansion. If they begin selling these parts not only to the evangelistic type of purchaser, but to the general public, people that would just like really high performance equipment and would like to use it because it works well, that's a huge opportunity for growth right there. On top of that, Fox Factory does a lot of research and development, and they're constantly changing and involving innovation in their components. They're developing brand new market segments, and then they're integrating their systems so that if you buy one piece, you probably want to buy the other 3 or 4 pieces that go with it. They also do a lot of after-sale services. Next slide. The second group is powered vehicles group. So you have a group that is self-propelled, and now you have a group that's propelled by a motor. Next slide, please. And there's significant penetration in this particular market already, and there's a lot of room for increased penetration beyond where they already are. The additional opportunities come with government contracts, they come from commercial contracts, they come from infrastructure contracts, they come from places that you wouldn't normally expect a company like this to operate, but just because it makes something go fast doesn't necessarily mean that it doesn't also make it move more efficiently. And the efficiency ideas are what's entertaining and what's bringing in government contracts and commercial contracts. Next slide, please. They do about 50-50 in their business. The growth rates are in the high 20s. The compounded annual growth rates are in the high 20s for both of the two segments of their business. Fox typically enters into new markets. I'm reading in the aftermarket channel. That means that they'll develop a part that people will replace on their original equipment with a Fox Factory part, and then drive end consumer adoption and brand value, which often then goes to OEM spec wins, which means the part, instead of being added by a racer or by an enthusiast, gets added by the manufacturer because it proves to be such a demand for that particular part. And again, the business is split fairly evenly, 50-50, between the two aftermarket channels and the original equipment manufacturing channel. Next slide. They've made a prediction for earnings per share growth in fiscal year 22 at about 23%. Keep that number in mind, please. Next slide. I've done an SSG. The lines are certainly beautiful. Some cyclicality in the earnings. It is a cyclical company, not highly cyclical, but cyclical enough that you can see it appearing in the earnings pretty well. Pretty consistent sales all the way through the cycles in earnings. Notice that with the company predicting 23% earnings per share for next year, I'm predicting about 15% earnings per share growth for the next 5 years. Using the preferred procedure, that's giving me approximately a 15% sales growth for that same time period. I'm looking at very reasonable debt to capital. I'm looking at average to above average return on equity, and the company's fairly profitable, and the profits, except for the pandemic year of 2020, the profits appear to be evening out at somewhere between 13.5% and 15%, which is great for a company this size. The company has moved from a very small base to being a good, solid, medium-sized company now. Next slide. Value line suggests that the earnings might grow for the next 3 to 5 years at 17%. So I think my 15% call is certainly within range of some of the other analyst community that is out there. And you notice that at the high end, the average PE has been a little bit above 40. At the low end, the average PE has been a little bit above 20, 40 and 20. Keep those numbers in mind. Next slide. And I'm choosing PEs that were 35 and 16. With inflation, with rising interest rates, I'm suggesting that PEs will probably move down. With growth in the high teens or maybe even in the low 20s, I think that the PE values at the high side of 35 are certainly reasonable. And I'm getting a buy, maybe a par value of 18% or so. Next slide. Manifest is getting a par value of 18.9%. I really think that gives me some validation for my own stock selection guide. Manifest places Fox Factory in the recreational vehicle industry and puts it at the top of the industry. The rest of them are you can see listed right there. The Morningstar system places Fox Factory in the auto parts industry, and you can see where Manifest feels some of the best auto parts companies are available. I think this is a tough one to place in a particular industry, and I think you'd have to be very careful in selecting peers because this is looking at high performance in addition to just plain parts for whatever they're looking at in the sports world. Next slide. Here's the discretionary sector where everybody seems to agree Foxfire belongs. And according to Manifest, Fox Factory certainly belongs in the top 5 companies in the discretionary sector. All in all, I think it's a good company for us to add $1,000 to, and we'll be adding $1,000 for Fox Factory.
Vroom, vroom.
Good evening. This is a store that's coming near your neighborhood. So I looked at Dollar General and Dollar Tree and Costco. My wife's favorite store is Dollar Tree. We do a lot of shopping with Costco because they're both within a mile in Traverse City and within 5 miles down in Florida. So we do a lot of shopping there. But, you know, you start looking at all the values and the history of sales growth, you know, they're pretty equal. So I just, when I looked at their webpage and looked at their last quarterly return, which was ended on July 29th, the net sales increased 9% to 9.4 billion. The same store sales increased 4.6%. Operating profit increased 7.5%. Diluted earnings per share 10.8% to $2.98. Year-to-date cash flows are up at $948 million. So they also declared a dividend of 55 cents. It's interesting that they are predicting a double-digit growth on earnings per share. So I just, you know, the total merchandise inventories have also doubled. They were 6.9 million compared to 5.3 million. So it's an increase of 25% per sale per store basis. Capital expenditures, they're just increasing, they're upgrading all their stores. They 255 million improvements, upgrades, remodels, and relocations of existing stores. So some of the stores are not in the right spot, so they move them. They put 210 million related to store facilities for leasehold improvements and fixtures and equipment. 157 million to distribution and transportation. So also 22 million in information system. The company opened 227 new stores, remodeled 533 stores, and relocated 30 stores. So the company is repurchasing stock at the price of $233, which is a little bit on the low side from where it's at. So also, it's interesting that net sales growth is going to be 11%, including the percentage of 53 week, approximately 2 percentage points from the 53rd week compared to its previous expectation of 10%. Same store sales up 4 to 4.5%. Diluted earnings per share approximately 12 to 14%. So in the coming year, the company now plans to execute 2,930 to 2,980 real estate projects, including 1,000 to 1,060 new store openings, 1,700 remodels, and 125 store relocations. This compared to the previous expectation of 2,980 real estate projects and 1,190 and 750. So they're continually expanding. So, it's amazing that how many stores are starting to get in every little city that doesn't have a grocery store, but they also are looking at expanding some of their information. Next slide there. So as you can see, this continues to grow up. So when I look at the value line, it just talks about that, yeah, they're going to be okay. It's good for a long-term holding. You're not going to see a whole lot of growth in here, but because of the economy the way it is, I really think that people are going to start going to Dollar General, Dollar Tree, and Costco for their shopping experiences, and they're not going to be buying the high-end products because it's just not going to be, the money's not going to be there for them to be able to do it. Next slide. So as you can see, their sales continually to go up. They did have a little bit of a tick down in earnings per share and profit, but they're starting to come back in the quarter, and so I think this is going to continue to be a quality stock for us to be able to look at. Next slide. So the pre-tax profit on sales are still averaging between 10 and 9%, average of 8.6% earned on equity. They're doing really good at 37%. Debt to capital has gone up a little bit because I think that with all the store remodels and what they're doing, and they're also buying back shares. So the PE on this is a little bit on the elevated side compared to the average. So it's one of those stocks that could be considered in the hold range, but so are all the other stocks that I have looked at. Next slide. So as you can see, I have projected a 7.9% annual return. So the buy zone is 220 to 296, and I think today the stock come in at 224. So it's getting a lot closer to that buy zone. Next slide. I think
that is your last slide, Herb.
The last slide. So I would really strongly urge everyone to put $1,000 into our portfolio for Dollar General, because I think this is where, when you have the market fluctuating like it is, this is a good stock to park your money.
It is fascinating to see the proliferation of these in all the small towns. A lot around here, and as we were up north here the last few weeks, and they seem to have a pretty good management style when it comes to doing that. And fascinating story when you look at how this company has performed through recessions. Yeah, I think it's a very interesting idea to look at.
Mark, we have a question that was raised during Herb's presentation. Judith, I'm going to unmute you, and you'll need to unmute yourself in order to ask your question. Judith Greenberg, you can go ahead and ask your question if you unmute. Okay, I'm going to assume that's an inadvertent hand then, Mark.
Okay.
And we can go on with the presentation, okay?
Ken, I can answer that question. Sometimes, it depends on management on individual stores. I think that, as they expand, they have to continue to look at how they're treating employees, because the tight labor force is going to force them to start figuring out how to train their employees more properly and make sure they have enough employees in each store.
Yeah, Herb is answering a question that came in through the question box, and the question was, should you consider how they treat their employees? And the questioner indicated that they had some knowledge that the employees weren't treated as well as they might be, and that's the question Herb is answering.
Okay.
Once again, Judith, if you have you had your hand up. If you have a question, if you'll unmute yourself, you can ask it. Okay, let's go on then, Mark. All right.
All right. So last month I caught a lot of grief for distributing these throughout the presentation, and I was accused of subliminal tinkering with the audience in the future vote. But I couldn't take this slide out because it still just kind of resonates with me. And I also would like to point out that Portillo's is the best performing stock from last month's roundtable. All right. So I went shopping for some stocks. I want some companies that have good return forecasts and high quality. So a manifest rank of 99 and above. So I chose 99 for a minimum. And then I also said, well, I want them to be potentially oversold, kind of beat down Hugh McManus style. So an RSI less than 50. And this is a pretty interesting list of some stocks to look at. Like Ken mentioned a few minutes ago, Generac, I think probably the storms here in the upper Midwest is a sign, maybe an omen that I should be picking Generac tonight, but I'm going to just let that one go. Littelfuse continues to be interesting. MKS, I mean, a lot of these have been talked about. This one is kind of fascinating. The expectations for Mesa Labs have kind of returned back to our old trajectories. You might want to take a closer look at Mesa Labs. And I personally want to see them deliver some of those results first, kind of a Missouri show me thing. But that kind of fell from grace in our community, but it's kind of a fascinating one. There's a number of other opportunities here. I like Siemens if Europe wasn't such a mess, but someday maybe that is a good longer term opportunity. And I just wasn't finding the type of companies that I wanted, so I wanted to go a little bit deeper into the oversold range. So I started looking for companies that are closer to a relative strength index of 30, perhaps trading near their 52-week low. And I found this company that I had never heard of before, 3M Company, Minnesota Manufacturing and Mining. And these guys have a pretty solid reputation for conducting research and developing new products and all kinds of stuff. And they are leveraged into all kinds of places that we know and love, like even electric vehicles and all kinds of healthcare related stuff, safety things, home improvement. They make solvents, they make adhesives, all that kind of stuff. And I suspect that very few of us go through a day without touching some of their products. So I was kidding. We know 3M pretty well, and it's a kind of an interesting company long term. I did discover that they have 4 main areas of business. They do make things like respiratory masks, medical safety equipment, stuff for auto shops, all kinds of construction-related materials, disposables, that kind of stuff. And they are also in the area of making film-type things for things like some semiconductor manufacturing. So you can actually dig in and look at this kind of stuff. The healthcare segment is actually one that they are looking at very carefully spinning off. And they have some fairly innovative solutions when it comes to dentistry and orthodontics, and just some very interesting areas of taking care of injuries and basically a bunch of supply to hospitals in terms of, again, safety equipment, garments, all that kind of stuff. And then they make a whole bunch of other stuff that you guys all know very well, the stick-it notes and tape, scotch tape, Ace bandages. That's the company we're talking about here. Here's a look at the company over time. Again, as you look at one of these summaries from Manifest Investing, you're basically looking at a preferred procedure right here. We often refer to it as an expected income statement too, but the assumptions being made here are this is up, straight, and parallel. The up isn't very big. It checks in at about 3%. Some analysts expect as much as 5% for that slope of this line, but we'll go with the 3% right now. So a $35 billion company chugging along at 3 to 5%. Their projected net margin is somewhere in the upper teens. You can see that it's fluctuated around a little bit. They have been doing some portfolio management, divesting some products, adding others, but this is a fairly favorable situation here as far as expectations, checking in at 17 to 18% when it comes to profitability. So again, it's fairly easy to justify a PE for a company like this in the mid-teens. They have been through a kind of a period of trial and different management and that kind of stuff, but it's fairly easy to justify a PE for a solid picture like this one in that 16 range. You get a bonus here with a dividend of about 3%. So the projected annual return, the return forecast is in the 14% range for this very high quality company. Their debt is strong. They don't have that much. What little that they do have, they have an effective mortgage rate of 2.7%. So that tells you what the banks think of the company. They do have $3 billion in cash on hand. And I do find it comforting that the projected return on value compares very favorably to the projected annual return up here. That's what we reconcile the two against. Here's an interesting number. The company as of today is trading at less than the 52-week low of yesterday. So it's trading at a brand new 52-week low. That interests people like myself and Hugh McManus. Value Line has a low forecast in the long-term forecast of $220 at a present price of approximately $125. That would be a return of 17% in their 3 to 5 year forecast. Morningstar sees a fair value of 183. So again, we're looking at a company as much as 30% off sale. And this is what brought me to it in the first place. A relative strength index of 26, 27, suggesting that the company is potentially oversold. Again, if they sort the things out, if they get all the duct tape in the right places, a pretty bright future for this company. They do invest between 6 and 7% into R&D compared with other companies in their line of work that are more like 2 or 3% per year. So they have a boatload of patents. They protect their patents pretty carefully. So they are able to be low-cost producers that basically charge a premium for their products. And it's quite a compelling long-term story. And again, like Hugh said just a few minutes ago, when Jerome Powell beats up on all of our companies and the prices drop, that should not make us depressed. That should basically get our ears up and look for opportunities. So I'm going to suggest that we accumulating a little, or actually initiate a position in 3M Company.
Mark, could you stay on that slide for a moment?
Sure.
We have a question that I've never considered, and maybe other folks in the audience have considered it. The person wants to know, does the proved value, the projected return on value at 11.6, does that take into account the dividend or not?
No, that would be basically outside the dividend. It's basically the operating profits, just like dividends are after earnings. And the same situation would apply here. We're basically looking at a pre-tax situation. So it's basically outside of dividends.
Well, you can guess the question then. The question is, to compare proved to par, would you add the dividend to the proved value to compare it to the par value?
It's an interesting question. What the projected return on value is intended to be is, it's not looking at CapEx or any of that other type of stuff that's below the operating line. You're basically talking about what is the operating profitability of this company in the future, and how does that compare to their market capitalization, their total liabilities, and their cash on hand. So I tend to think of, the decision to pay a dividend as downstream. So no, it's actually downstream of that.
Okay, I'll leave it at that.
Okay, probably something we'll be pressed on a little bit more in the future. We might have to get out some of the Greenblatt, our modified Greenblatt slides and explain that away. All right, so there you have it, 3M, a relatively unknown company that is now at prices last seen about 10 years ago. Okay, and with that, Ken, I think we can go to the poll.
Okay, if you give me just a chance, Mark. And there we go. The poll is open, folks. Which one of these companies would the audience like to take a stand in? You can also vote for none of the above. Doesn't cost anything to vote. Just take your mouse and pick one. If you have a touch screen computer, you can touch the value. I'd like to get at least 90% of our audience voting.
Do I need to do any promising of Portillo's products?
And I'm going to close the poll. And I'm going to share the results. And Mark, folks like blue chips. They like 3M.
Are you serious?
About a tie between Dollar General and Fox Factory, but they really like 3M. You got a little bit less than half the votes, Mark.
I can never figure this audience out.
You offered them food.
Are you speechless, Mark?
I am a bit speechless. I mean, I have just been rocking the results for the last year, and the audience never votes for my picks. And now this one was kind of ordinary, maybe strong, but ordinary. Oh well.
Okay, I'm going to close the poll and we can continue.
Okay.
I think you're trying to say that you're shocked by the genius of the audience.
Well, yeah, I am. I'm definitely thinking that. Wow. All right. Just a reminder to everybody that we do archive all of these roundtable sessions and our bull sessions on YouTube. Just look under Manifest Investing. The videos are listed there. For example, the session, well, I don't actually have a current one of these, but the sessions we talked about earlier in tonight's roundtable are archived there, so you can go and take a look. Please consider subscribing. We'll let you know when new content is added. And as soon as we get to 1,000, we actually have a few more doors kicked open to help more people learn about the Modern Investment Club movement, and I think that's a good thing. All right, just as a reminder, we do have some coming attractions coming up. We do the Tuesday sessions at 2, bull sessions, and they are on YouTube if that doesn't work for you during your work day. The September Roundtable is exactly 4 weeks away on September 27th, and the October will be a month after that. We will have our Best Small Companies for 2023. That's a Saturday, October 29th. Ken, I know you and I haven't talked about that, so that's open to change if that doesn't fit your schedule. But that's the current target date. And the Mid-Michigan Stock Pickers will be just short of Thanksgiving in early November. What's the location for that, Ken? What's the current thinking on that?
It's up right now. It's face to face. It's live up in Saginaw at the Horizon Event Center. That's where we've held it for the last 10 or 12 years. But we'll have to see, Mark, when we get closer, what COVID is doing and what the event center itself is doing, and frankly, what our registrations are doing. We'll have to make sure that we can break even on the event.
And you're before deer season.
Well, we're always before deer season. We're always picking right the Saturday before deer season or the Saturday deer season begins. So that's just a We've been doing that for a long time, so
Yeah,
that should part of it should work out.
I have actually made the drive back from Saginaw and watched a station wagon go by with a deer on the hood and a Christmas tree on the roof of the car. So I've actually
So,
seen that happen. And Ken and I are
Mark,
working on a program in Troy, Michigan with AA, and there will be others added to this. Ken and I, we need to compare notes on some of this
okay.
stuff.
We're getting a question about that AA. It's going to be somewhere in Troy, Thomas. And if you'll watch Manifest Investing, you'll get an update on the exact location when it comes a little bit closer.
And that one's also subject to all the disclaimers about finding the venue and COVID could interfere. Ken and I just experienced an event where it had to be canceled because of the change in the venue constraints down in Indianapolis. But we did have a good online show for that one.
Okay. Mark, I've kept up with the questions, so I want to say thank you to Herb for filling in on fairly short notice. Hugh, it's so nice to have you with us again. And Mark, revel in your victory tonight. They don't happen very often. So is that a backhanded enough compliment for you? Okay.
Well, I was thinking about putting a picture of Rodney Dangerfield on the cover slide. Yeah.
So I just want to say good night to everybody. Audience, thank you so much for showing up on this August evening. And we'll look for you all again at the end of September.
Thanks,
you, everybody. Thanks, Herb. Enjoy that ice cream.
Oh, yeah, always.
I'll be up to help you with that sometime soon.
Good night, all.
Bye, everyone.